Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and another divorce mortgage planning video quick tip. Whether you're a family law attorney helping a client or a homeowner navigating divorce, mortgage financing doesn't have to be overwhelming. With the right divorce mortgage planning strategies, you can move forward confidently, knowing you've protected settlement funds and created opportunities for post-divorce housing solutions. In today's video, I'll review key aspects of how proper divorce mortgage planning can help family law attorneys support their clients and also assist divorcing homeowners achieve successful outcomes. And if you've not yet done so, make sure to download our free divorce lending blueprint for success with the link below. It's a valuable tool for understanding the divorce mortgage planning process and how divorce affects the potential loan programs available. Divorce credit scores and mortgage approval. What credit activity moves a score, and what can derail your Florida divorce refinance? Credit score confusion is one of the fastest ways for a workable settlement to become an unworkable mortgage file, especially when the agreement relies on a refinance, equity buyout, or time-sensitive purchase underwriting, as is common in Florida divorce refinance planning. We previously reviewed how mortgage credit scores are weighted and why the score your client sees is often different from the score a mortgage lender uses. This follow-up part 2 goes one level deeper. The 5 categories stay the same, but the credit behavior inside them can shift quickly during divorce, and those shifts can make the difference between a loan approval and denial. If you are building settlement terms around a refinance or mortgage approval, the goal is not simply to improve the score, but instead the goal should be to identify which category is likely to change, why it is changing, and whether the change creates a guideline or underwriting risk. This post answers 2 common questions. What type of credit activity drives the score categories? And which items tend to create immediate mortgage qualifying problems during divorce? Mortgage credit scores are generally built from 5 categories. The categories are consistent, but the activity that occurs inside each one is what lenders and underwriters focus on when the file moves through the loan approval process. First off, we have payment history. A consumer is viewed as higher credit risk when major recent delinquencies are present, particularly if the delinquency is recent, recurring, or still active at the time of underwriting. During divorce, delinquencies often come from accounts that were supposed to be paid under temporary orders or informal agreements. Regardless of the reason, this can still result in a late payment that reports and can impact both the score and mortgage qualification. Common delinquency examples include charged off accounts. These are debts that are deemed unlikely to be collected after substantial delinquency has occurred. Collection accounts, unpaid negative debt that has been sold or assigned to collections, and late payments of 30, 60, 90 days or greater. Even a single 30-day late can create downstream mortgage qualification issues for months. Underwriters also pay attention to the story behind late payments, especially when they involve joint accounts, housing-related obligations, or a pattern that appears ongoing. From an underwriting perspective, the recency of a delinquency often matters as much as the severity, and the type of collection also makes a difference. While both medical and non-medical collections can impact the score, mortgage guidelines provide greater flexibility for medical collections as opposed to consumer credit cards, utilities, or rental leasing collections. Another major category is credit utilization. Utilization evaluates revolving debt compared to available revolving credit limits. It can move a score materially even when payments are made on time. This is one of the most influential factors in a score because it is something that can be changed in a very short time frame, for both good and bad. Divorce can trigger utilization spikes when a household shifts to one income, a spouse stops contributing, legal fees hit credit cards, or balances are moved between accounts. With credit utilization, the primary driver is the ratio of total revolving debt as compared to total revolving credit limits. For example, you would add the balances on all revolving accounts, typically credit cards and any applicable HELOCs, and divide by the total available revolving credit limits on those accounts. Lower ratios will improve your credit scores, while higher balance to credit limits will decrease your scores. Depending on the timing and the scenario, rapid rescoring may be an option. Score simulations and targeted paydowns can help determine whether a refinance timeline is realistic before settlement terms are finalized. Under length of credit history, scoring looks at the age of the oldest and newest active accounts and averages those ages across the profile. A common divorce pattern is credit surfing, where you're opening new cards for short-term liquidity or promotional offers. That can help cash flow, but can also reduce average account age at the worst possible time, right before underwriting. Divorce planning can often include closing joint accounts. Before accounts are closed, confirm the mortgage strategy so a long-standing account is not removed without a replacement plan, particularly if the client's independent trade line depth is thin. Credit mix reflects the types of accounts on the credit report: revolving, credit cards and HELOCs, installment, auto loans, mortgages, and student loans, and also open accounts, such as certain American Express products. Some finance company accounts can be viewed as higher risk. For mortgage qualifying, the objective is not more accounts. The objective is a stable profile with manageable payments and no new risk signals during underwriting. With regards to new credit and inquiries, inquiries can affect a score based on volume, type, and recency, often within the last 12 months. Mortgage and auto inquiries may be treated differently under rate shopping deduplication logic, but the window can vary. During divorce, new credit is often opened out of necessity. If new debt is unavoidable, the timing and payment impact should be evaluated alongside debt to income ratios, the refinance or purchase timeline, any settlement language requiring removal of a spouse from liability. Beyond the 5 categories, underwriters also scrutinize report level issues that may not be obvious from the score alone. And remember to watch out for special circumstances during divorce. Mortgage qualifying guidelines vary by program, lender overlays, and a specific credit event. These items should be reviewed case by case because their scoring and underwriting impacts can differ. Disputed accounts can be masked from scoring while still creating underwriting questions. Authorized user accounts can help or hurt depending on how the primary account is managed and whether the lender accepts a trade line for scoring or underwriting purposes. And for collection accounts, look out for medical versus non-medical, and also public records and major derogatory events, such as tax liens, bankruptcies, foreclosures, and short sales. Credit understanding is critical in divorce planning. Each category ties back to underwriting decisions that affect settlement feasibility. In practice, payment history and utilization are the 2 areas most likely to change during divorce, and they are also the 2 most likely to create immediate loan eligibility problems when the refinance or purchase is time sensitive. When a settlement requires a refinance to remove a spouse or access equity to buy out their interest, it is best practice for credit report analysis to occur before final agreements are signed and not treated as post-decree cleanup items. And it is a drafting tip. Use the right credit conversation during MSA negotiations. If the negotiations rely on a refinance or new purchase, avoid basing decisions on consumer-facing credit monitoring tools. Instead, anchor discussions to what is actually reported in the credit report, how each debt will be treated for mortgage qualification, and what score improvement is realistic based on specific actions such as paydowns, removals, or deletions. We can model these changes up front before settlement terms are finalized, so financing plans are built on underwriting reality rather than assumptions. Do you need help interpreting a client's credit qualifying ability? Our second opinion service is here to assist, provided at no cost to support your case strategy. A second opinion service review includes a full review of the client's credit profile, guidance on how each account type will be treated for mortgage qualifying, simulated credit score and debt to income ratio changes before decisions are made, identification of hidden mortgage qualification risks, and recommendations on how to align the marital settlement agreement with mortgage guidelines. Request your confidential review today to protect your client's financing options and avoid last-minute surprises that disrupt settlement terms. Remember to just call, text, or email to schedule your confidential loan consultation, and let our divorce mortgage practice group go to work for you and your clients.